The next adjusting entry was this information in item C. It says interest rate's 12% and is payable annually on April 1st. So what are we talking about here? Well, we're talking about something that's payable annually that would have an interest rate, and that sounds like what we're talking about here, and it is. It's interest on the loan. So if we look back to our story, on April 1st of year 3, Sample Daycare borrowed $10,000 from the bank. It was a 2-year note payable. So we borrowed $10,000 on April 1st. The note has a 12% interest rate, and time has passed. What kind of adjusting entry could we be talking about there? Well, for adjusting entries, you can take a similar approach to what we did in basic transaction analysis. What accounts are involved? We know that there's one balance sheet and one income statement account. Should they get larger or smaller, and by how much? We know that cash is not involved. Well, what's the point of this adjusting entry? We're being told that there's a 12% interest rate, so obviously we're being asked to record some interest. In this case, since we owe a bank $10,000, it's interest expense that we need to record. So we know that we'll have some sort of negative amount being entered over here because we'll be recording some interest expense. What's the balance sheet account that's involved? Well, in this case, it's going to be a liability, interest payable. You could just tack the interest onto the note amount, but it's advisable and certainly preferable in our case to instead put it in a separate interest payable account. Keep the interest amount separate from the loan principal amount. So what we'll be doing in this entry is increasing a liability, interest payable, and decreasing equity to record the appropriate amount of interest expense. So this is one of those accrual type adjusting entries that were discussed in the class notes. How do we do the computation? This formula should look familiar to you. Principal times rate times time. You take the principal amount of the loan, in this case $10,000. If you multiply it times an annual interest rate, and I will always give you an annual interest rate, the principal times an annual interest rate would give you interest for an entire year. So you then need to multiply that times a portion of a year to prorate for a shorter period. Principal times rate times time will give you interest. In this case, it's going to be interest expense for the period of April through December 31st. So try to do the math on your own, and we'll check it here in a minute. Okay, well, hopefully you came up with the same thing I did here. Principal times 12% interest annually. Multiply that times the portion of a year. They borrowed the note on April 1st. So April's the 4th month of the year. Don't make the mistake of taking 12 minus 4 and getting 8. They owed the loan for all of April as well. So April through December is actually 9 months. 1,200 times 9 months is $900 for 9 months worth of interest. So our adjusting entry in this case, we had a zero beginning balance in the interest payable account. Our adjusting entry increases interest payable and increases the interest expense account, which decreases equity by $900. On our balance sheet at the end of the year, we'll show an additional liability of $900 of interest payable, and on the income statement, we'll show $900 of interest expense. In this example, Sample Daycare isn't paying any interest until April. So when April rolls around, April of year 4, Sample Daycare will write out a check to the bank for $1,200. When they write out that check for $1,200, cash will go down by $1,200. Interest payable will go down by $900. They're paying off this short-term loan in effect, and they'll record an additional $300 of interest expense in year 4. The $300 of interest expense in year 4 is for January, February, and March of year 4. So this adjusting entry helps us get the correct amount of interest expense into year 3 versus year 4. Now, if Sample Daycare had loaned somebody else $10,000 on April 1st of year 3, and somebody else hadn't paid any interest by the end of the year, then Sample Daycare would do this exact same math down here, and they would be recording interest receivable of $900 and interest revenue of $900. So you use the same formula, it only changes the accounts that are involved. Now let's move on to item D that says depreciation is based on a 10-year life. SL stands for straight line. That refers to our method of depreciation. And we have no residual value. Well, let's talk about what all of these terms mean. First of all, depreciation is a very common adjusting entry. Any company that has property, plant, and equipment type assets, long-lived assets that are being used up, like equipment, machinery, buildings, those types of assets. So these are assets that when we buy them, we record them at their acquisition cost, and then we reflect the fact that those assets get used up over time by recording something we call depreciation expense. Depreciation expense is not intended to reflect a decline in value of the asset. Instead, it's intended to reflect a decline in the utility of the asset. So depreciation expense is simply the allocation of the cost of this type of asset to expense over its useful life. The allocation of the cost of an asset to expense over its useful life. And actually we'll have a whole unit on this later on, but companies are allowed to use almost any method they want as long as it's a rational method and they use it consistently. By far, though, the most common method that companies use is called the straight line method. It's very simple. Let's take a look at the information that we have in the trial balance and see if we can decide what this depreciation is even aimed at adjusting. So I've gone back to the trial balance and I'm scanning down our assets, and here we see it. In the case of Sample Daycare, the type of asset that would be depreciated is furniture. So we have the furniture account with a $22,000 balance. The balance in the account would represent the original acquisition cost of the furniture. So we don't know when it was purchased, but it was purchased prior to the beginning of year 3. So they held this furniture. They used it up for the entire year, year 3. A related account to furniture, a buddy account to furniture, is this accumulated depreciation account. The accumulated depreciation account is, of course, a contra asset. It has a contrary balance, if you will. So it's a negative asset account. Normal balance would be a credit, where for furniture, the normal balance would be a debit. So this accumulated depreciation account reflects the amount of the original cost of $22,000 that's been expensed as depreciation expense so far over the life of the furniture. So we don't know when they bought the furniture, but in the years prior to December 31st, year 2, they've recorded $3,200 of depreciation expense in total cumulatively. Let's put these balances in our accounting equation to help us do our adjusting entry. Okay, so under assets, here's our $22,000 cost of the furniture and the negative $3,200 asset, because remember this is a contra asset. So accumulated depreciation. Again, similar to expenses, if I asked you what was the balance in the accumulated depreciation account, at the beginning of year 3, you would simply say $3,200 because accumulated depreciation should normally be a negative asset. In the equation, though, since we're showing this under assets, that's where you see it as a negative account. All right, well, let's talk about how we compute depreciation. We now know that this is what we'll be depreciating. The standard form of an entry for depreciation would be to record depreciation expense, so we know we're going to have a negative under retained earnings because depreciation expense, like all expenses, reduces retained earnings. The other side of the entry is going to be a negative under assets. We're going to increase this negative contra asset. We're going to increase this contra asset by the amount of our current year's depreciation expense. So this is going to be a negative number here as well. So to record depreciation expense, we'll reduce assets and reduce equity. We will increase the accumulated depreciation account and increase the expense account. Remember, the negatives that you're seeing here are reflecting the effect on these general categories of accounts. Let's take a look at the computation. This is our formula for straight line depreciation. For straight line depreciation, a company takes the original cost of whatever asset it's depreciating, and here we're just going to do it all as one lump sum, assume they all have the same useful life. They subtract something called the residual value. The residual value represents what the company thinks they can sell that asset for when they're done using it. In this case, it says no residual value, so residual value is 0. So take your $22,000 of cost and divide it by the useful life. The useful life has to be estimated by management, and management estimated it to be 10 years. So doing the math, the numerator, 22,000 divided by 10 years would give us 2,200 per year. We've owned the equipment for the entire year 3, so our depreciation expense should be 2,200. We decrease assets, we decrease equity, and the actual temporary account title would be depreciation expense. After we record our year 3 adjusting entry for depreciation, the accumulated depreciation account will have grown to $5,400. A negative plus a negative is a larger negative here. So this amount tells us this amount represents the utility of a portion of the acquisition cost of the furniture. These two accounts have to be considered together. If Sample Daycare ever sells the furniture, it has to take off its books both the furniture and the accumulated depreciation account. These two accounts are integrally linked to each other. We call 22,000 minus 5,400 the net book value of the property, plant, and equipment. Cost minus accumulated depreciation is referred to as the net book value of property, plant, and equipment. And a lot of times what you would actually see on the balance sheet for a company is just the $16,600, the net book value. But because when we wrote off the cost of the furniture, we put the $2,200 as a minus to accumulated depreciation instead of just straightforward subtracting it from the furniture account, a reader could potentially also have this other more detailed information. So instead of thinking that they have furniture that's on the books for $16,600 and not having any idea how old the furniture is or any other detail at all, a reader at least can know that the furniture has $22,000 of acquisition cost, and it's about 25% of the way through its useful life. Those companies who only give you net book value on the face of the balance sheet will provide in the footnotes to the financial statements detail about cost and the accumulated depreciation amount. So you can find this detail either on the face of the balance sheet or in the footnotes. All right, well, we're through all of the given bits of additional information. The thing in Part E just asks you to consider, are there other accounts that, because we're familiar with how we recorded the transactions during the year, are there other accounts that we know need to be adjusted? And in fact, there are at least two that are obvious to us. We know that Sample Daycare received a bunch of cash in advance on a daycare contract. I believe it was $12,000 received in advance. It was received sometime during the year, and the daycare contract wasn't going to start until October. And we applied our rule of thumb, and we recorded all $12,000 of that cash received in advance as unearned revenue, but some months have passed, so we know we've earned some. Similarly, Sample Daycare paid, I think it was $3,600 for 6 months worth of rent in advance, and we know that a couple of months of that lease have expired. They've used up some of the benefit of that 6 months. So we know that there's a prepaid rent that needs to be adjusted and an unearned revenue that needs to be adjusted as well. Let's start with the daycare revenue adjustment and take a look at where we stuck that $12,000 and how we need to adjust it. Now remember, we could have done this different ways. We could have put all $12,000 as daycare revenue. We could have put all $12,000 as unearned revenue, or we could have done some of it as unearned and some of it as revenue. We followed our standard rule of thumb, which would say record the entire amount as unearned revenue and adjust it later. So here, very standard rule of thumb. But similar to what we did with office supplies and daycare supplies, we could have recorded this all as revenue and we still would have been able to do a single adjusting entry that would have corrected both accounts. We would have ended up in the same place for adjusted balances when we were done. Let's go back and look at the original story here. On August 12th of year 3, Sample Daycare got this $12,000 check. We don't care about the date we got the money. What we care about is how much of this $12,000 was earned during year 3, because we need to apply the revenue recognition rule and the accrual method. So the contract actually started October 1st of year 3, so they would have earned October, November, and December. 3 months of this contract would have been earned. The other 9 months would be unearned as of the end of the year. Let's see, so I did some quick math over here. It was a 12-month contract, and when you're doing these problems, make sure you read all the details, read very carefully. It could have been a 24-month contract, then you'd be coming up with $500 per month. Look carefully at the dates, double check your work. In here, it was $12,000 for 12 months, so that's $1,000 a month. We said that 3 months has been earned, October through December, and the rest of it is still unearned at the end of the year. So we know that the adjusted balance in the unearned revenue account should be the amount that still has to be earned in the future, $9,000. That gives us our required adjusting entry. Our required adjusting entry here then would be that whatever it takes to get the unearned revenue down from $12,000 to $9,000. It happens to be $3,000, so our adjusting entry decreases the liability by $3,000 and increases, of course, daycare revenue, because we're saying that's the 3 months that we earned. I would recommend that you approach it this way. Instead of saying, I know we earned $3,000 and doing your entry for the $3,000, instead focus on the balance sheet account, or at least audit the balance sheet account. If there had been a beginning balance in the unearned revenue account before this $12,000 was added to it, you would need to pay attention to that and think about whether that beginning balance had also been earned during year 3. Here that wasn't the case. Alright, well, let's consider the last adjusting entry that we need to do here, and that one was, of course, for the prepaid rent. So as we recall, Sample Daycare paid $3,600 for 6 months worth of rent that began on November 1st. So if we do the same kind of analysis that we did previously For the daycare account, it would look something like this, right? They paid $3,600. It was for a 6-month lease, so $600 per month on the lease. 2 months of the lease have gone by, so that's $1,200. 2 times 600. That means the other 4 months, or $2,400 of that 6-month lease, is still good as an asset. What students often do is jump to the $1,200 and record rent expense of $1,200 as their adjusting entry. Let's do that and see where we end up. The prepaid rent account has $3,900 in it. If we record our adjusting entry as a reduction to prepaid rent of $1,200 and our rent expense of $1,200, does that accomplish what we wanted it to accomplish? Well, if you do the math, after we reduce prepaid rent by $1,200, we still have $2,700 in that account. And that's why I told you in the previous section that you want to audit this balance sheet account and really focus on getting this right. What did we say we wanted to have as the correct balance in the prepaid rent account? Well, down here, it's 4 months, $2,400. So why is this $2,700? Well, the key is that the unadjusted balance in the account wasn't the $3,600 that we paid. It was the $3,600 that we paid during year 3. Plus, if you go back and you take a look at our earlier work, there was a $300 balance in the prepaid rent account before the accounting period began. So this was left over at December 31st, year 2. Well, the accountant would have to ask themselves, what happened with this $300? And of course, if you were the accountant, you'd be able to dig out the contract and look it up. Here it makes sense to assume that, if they paid another 6 months worth of rent up here, that this prepaid rent that was still an asset at the end of year 2 must have expired during year 3. So what we know is, if indeed that $300 would have been used up during year 3, and it's likely in this case, our adjusting entry would need to be for $1,500 to get the prepaid rent account correct. So we would need to record $1,500 of rent expense for year 3. What's that $1,500? Well, it's 2 months of the $3,600 contract plus that $300 that was on the books at the beginning of the year. So, a reminder, always after your adjusting entry, audit the balance sheet account. Make sure you've accomplished what you intended to accomplish with your adjusting entry. It's a really important step. Alright, so hopefully you've been recording these entries in our worksheet here as we've gone along. After recording each of those entries officially in our worksheet over here, you can see these would be what we would call the adjusted balances in the account. So we can see the balances and the ones we adjusted. Prepaid rent is now $2,400, office supplies $400, daycare supplies $100, accumulated depreciation is $5,400. There's our interest payable of $900. And then, of course, as part of the adjusting process, we had all of these revenue and expense accounts that need to be adjusted, and we did that adjustment here in the retained earnings column. The next step, of course, is to go ahead and use all of this analysis and organization that we've done to prepare financial statements for Sample Daycare for the year ended December 31st, year 3.